Hi class, today we're going to be looking at chapter 17, problem 4B. We're going to be doing the third video, which has to do with profitability. So I'm going to share my screen with you. You should be able to see chapter 17, 4B Excel spreadsheet that I've made up for this problem. And what we're going to be doing today is we're going to be learning about profitability ratios. And profitability ratios are ratios that we will use to help measure whether or not a company is going to be able to generate future earnings. So there will be 8 profitability ratios that we're going to be looking at today. And the first one is going to be what we call the asset turnover. And the asset turnover, what we're going to be doing is dividing our sales by our average total assets. So what we're going to need to look at, and if you'll just bear with me just a second. Let's see if I can move my screen. There we go. What we're going to be looking at is the income statement for the amount of sales. You will remember that we have been working with the problem dealing with year 2. So we're going to be looking at year 2 sales, and the sales amount is $10 million. That sales amount is going to be divided by what we call the average total assets. Your total assets, of course, would be found on the balance sheet. So what we're going to be looking at is the beginning assets, which would be the ending assets for 2001, plus the ending assets for 2002. And then we're going to take the sum of those and divide it by 2 to find the average total assets. And so when we do this, what is going to end up being is the amount of 1.1 times. So again, the asset turnover is where we're going to divide our sales for the year 2000 Y2 by the average total assets. To find the average total assets, we have to take the beginning total assets, which comes from the ending total assets in year 1, plus the ending total assets of year 2. The sum of that is divided by 2 to get the average total assets. So divide sales by the average total assets, it'll give you 1.1 times. This measures how effectively the company uses its assets to make a profit. And it is a profitability measure. And what you would want to do is compare that with what has happened in the year before. We are unable to make the calculations for year 1 because they did not give us the beginning amount of assets for year 1. So to find the asset turnover, we simply divide our sales by the average total assets. Our second profitability ratio that we're going to talk about is what we call a return on total assets. And this ratio is found by dividing the sum of the net income plus the interest expense. So you're going to take net income and add back in the interest expense. And you're going to get that total and divide it by the average total assets, which were calculated the same way that we calculated the average assets for the asset turnover. We're going to take the beginning total assets, which really is the ending total assets for year 1. We're going to add to it the ending total assets for year 2, and that total is going to be divided by 2 to find the average total assets. So the reason that we take the net income as the denominator figure plus the interest expense. We want to add back in the interest expense. So it'll show us how much of the company's profitability results from measuring the return on total assets without considering how the assets are actually financed. So interest expense is a part of the financing activities. When you add that back to net income, it kind of takes that interest expense out. So the net income plus the interest expense is your numerator, which you will divide by the average total assets, which is the denominator figure. And in this case, it gives you 11.5%. Again, we would compare that with what happened in the year before, but we can't make the calculations for the year before in this problem because they did not give us the beginning total assets. So this is how we calculate the return on total assets. We're going to divide the sum of the net income plus interest divided by the average total assets. The next profitability ratio that we need to talk about is a return on stockholders' equity. And what we're going to do is we're going to take the net income found on the income statement, and we're going to divide this by the average total stockholders' equity. The average total stockholders' equity is your beginning total stockholders' equity that comes from the ending total stockholders' equity of year 2. We're going to add that to the ending total stockholders' equity of year 1, and that sum total will be divided by 2. And what this will do is it will tell us, or it'll help us to measure the rate of income earned on the amount that's invested by our stockholders. And it too is a profitability measure. The amount of the return on stockholders' equity is 13.3%. Again, you would compare that with what happened last year, but since we don't have the beginning stockholders' equity from year 2000, let's say, you could not make those calculations. So we don't have the first year's return on stockholders' equity calculated for us. They're only asking for the second year. And again, we're going to divide the net income by the average stockholders' equity to get the return on stockholders' equity. Also, as a profitability measure, we can find the return on just common stockholders' equity. You might remember that in this problem, we were selling preferred stock as well as common stock. So if you want to know what the return on common stockholders' equity is, you would have to take the net income and subtract out the preferred dividends. The preferred dividends are given to you on the retained earnings statement that's up above in this Excel spreadsheet. But you take net income, subtract out your preferred dividends. That's your numerator part. Then you're going to divide it by the average common stockholders' equity. And to find the common stockholders' equity, we're going to take our beginning common stockholders' equity and we're going to add the ending common stockholders' equity to that and divide it by 2. And to find the common stockholders' equity only, it's common stock plus retained earnings. So the denominator figure is the average common stockholders' equity that we find by taking our beginning common stockholders' equity, which consists of common stock plus retained earnings. And we'll add to that the ending common stockholders' equity, which comes from year 2, which is your common stock from year 2 plus your retained earnings from year 2. The total of those is divided by 2. And the return on common stockholders' equity measures the rate of return earned on the amount that's been invested by just the common stockholders. It too is a profitability measure. The next measure that we're going to be looking at is what we call earnings per share on common stock. Notice it says common stock here. So when we're calculating earnings per share on common stock, we're going to take the net income as the numerator, less the preferred dividends that comes from the retained earnings statement. And we're going to divide that by the number of common shares outstanding. You are not given the common shares outstanding in this problem. What you're going to have to do is take the par value of the common stock and divide it by the par value per share of the common stock. And that will tell you the amount of common shares outstanding. In other words, on the balance sheet, when you look at common stock, the total par value of common stock is 500,000. We will divide that by the par value per share, which is $5 that is given on the balance sheet. And that will give you the number of common shares outstanding. This common shares outstanding becomes your denominator, which would be divided into the numerator, which consists of net income minus your preferred dividends. So the common earnings per share is $8.55 for this particular problem. The last two profitability ratios that we're going to be looking at are price earnings ratio and dividends per share of common stock. So the price earnings ratio we're going to look at first. And what we're going to do is we're going to divide the common market share price, which is given. And if you look at the top of this spreadsheet, you can see the market price. And you're going to divide it by the common earnings per share. That's what you just found in the ratio for earnings per share on common stock. So we're going to take the market price and divide it by the earnings per share, and that will give you a price earnings ratio of 14. The last ratio that we're going to be looking at for profitability is dividends per share on common stock. And what we're going to do is we're going to divide our common dividends that comes off of the retained earnings statement by the common shares outstanding. Again, you have to find the common shares outstanding, and we find it the very same way that we did when we were calculating the earnings per share. You're going to take your common stock total par value amount that's on the balance sheet and divide it by the par value per share. The common stock total par value is 500,000 in year 2. We're going to divide it by the par value of $5. That gives us 100,000 shares of common stock that are outstanding. You would divide the common shares outstanding into the common dividends that came from the retained earnings statement for year Y2. And that will give you 50 cents as the dividends per share on the common stock. And then yet there's one more. I thought there was just those two, but there's one more called the dividend yield. And the dividend yield, we're going to take and divide the common dividends per share. What we found in this one right here, the dividends per share, we take this 50 cents here, and we're going to divide it by the market share price, which was given in your problem. And that will give you a dividend yield of 0.42%. The dividend yield measures the rate of return to common stockholders from dividends, and it too is a profitability ratio. So this is the last video for this particular problem. And these are all of the profitability ratios that we've discussed in this particular video. So we'll stop sharing my screen with you and we'll see you next time. Bye-bye.